What if the reason you can't afford a home isn't just the economy? What if the real reason you keep getting outbid, the reason your rent gets bigger every year, is because you're not just competing with other families, you're competing with Wall Street? It might sound like a conspiracy, but for millions of Americans, it's a harsh reality. Massive hedge funds and private equity giants are buying up thousands of American houses, turning the dream of homeownership into a rental nightmare. They're your new landlords, and they operate on a scale that ordinary people just can't match. But now, in a move that's sending shockwaves through the financial world, a new proposal from Donald Trump aims to declare all-out war on these corporate landlords. In a social media post on January 7, 2026, President Trump announced he is immediately taking steps to ban large institutional investors from buying more single-family homes. He says he'll call on Congress to make it law, stating simply, "People live in homes, not corporations." Could this finally level the playing field? Is this the move that could lower your rent, or maybe even create the perfect opportunity for you to buy your first home? We're breaking down every angle of this high-stakes battle: who these Wall Street landlords are, how they took over your neighborhood, and what Trump's proposed ban could mean for you and your money. This is a big one, so stick with us. To really get what's happening, we have to go back to the aftermath of the 2008 financial crisis. The housing market had collapsed. Foreclosures were everywhere, and there were millions of cheap, empty homes sitting on the books of banks desperate to unload them. Into that chaos stepped a new kind of buyer, not a family, but Wall Street. Private equity firms and hedge funds saw a golden opportunity. They realized they could buy foreclosed homes not by the dozen, but by the thousand, and then rent them out. This was the birth of the single-family rental industry as we know it. Companies you've probably heard of, like Blackstone, created subsidiaries like Invitation Homes. Others, like American Homes, For Rent and Progress Residential, were created specifically to cash in. Their business model was incredibly effective. They didn't need a mortgage. They showed up with all-cash offers, often buying homes in bulk, sight unseen. A regular family trying to get a loan and needing an inspection just couldn't compete. As one professor at Cornell put it, when someone goes out to buy a house and there are multiple bidders, then a company with an advantage can come in and pay in cash and waive an inspection. That's infuriating. But this wasn't just about cheap foreclosures anymore. As the market recovered, these firms kept buying, using sophisticated algorithms to pinpoint neighborhoods with the potential for high rent growth. They targeted starter homes, the exact properties that have always been the first step for American families to build wealth. Now, let's get the scale right. Some viral posts claim these megacorporations are buying 30% of all homes. The reality is more nuanced, but still concerning. Nationally, large institutional investors, firms owning 100 or more properties, own only about 1% to 2% of all U.S. single-family houses. If you look specifically at single-family rentals, their share is around 3%. So if the national numbers are that small, why does it feel like such a massive problem? Because their ownership is highly concentrated. Think of it like pouring a gallon of water on a football field versus pouring it into a bucket. These firms have targeted specific, high-growth cities, mostly in the Sun Belt. In metro areas like Atlanta, Phoenix, and Charlotte, their footprint is dramatically larger. For instance, in some parts of Atlanta and Jacksonville, institutional investors own a significant share of the rental homes. In fact, a U.S. Government Accountability Office (GO) report noted that by 2022, these large firms had amassed portfolios of about 450,000 single-family homes nationwide. This concentrated buying has a magnifying effect. Even if they don't own most of the homes, by being the most aggressive buyers for entry-level houses, they effectively set the prices for everyone. Research shows that when these large investors enter a market, it can push up both home prices and rents. They don't need to own the whole neighborhood to distort the market. They just need to control enough of the available homes to turn would-be buyers into long-term renters. However, there has been a crucial, recent shift. Over the last couple of years, as interest rates have climbed, the pace of their buying has plummeted. Data shows that institutional purchases have fallen by as much as 90% from their peak in 2022. Some of the biggest players, including Blackstone, have actually become net sellers, meaning they're selling more homes than they're buying. Some insiders claim the growth window has closed and the industry is already pivoting to other models, like building entire neighborhoods specifically for rent. But for the millions living where these firms already have a deep footprint, the damage is done. The landscape of homeownership has been fundamentally altered. The data tells one story, but the human cost tells another. This isn't just about spreadsheets. It's about the erosion of America's most cherished promise, the American dream. For generations, owning a home wasn't just about shelter. It was the primary way to build wealth, establish stability, and put down roots in a community. That dream is now increasingly being offered as a subscription service, and you're paying the monthly fee. Imagine this scenario, which plays out every day. A young couple does everything right. They work hard, save for a down payment, and get pre-approved for a mortgage. They find the perfect starter home. They put in a competitive offer, maybe even a little over the asking price. Then, they get the call. They were beaten by an all-cash offer, no inspection needed, from an LLC they don't recognize. That LLC is owned by a multi-billion-dollar fund 1,000 miles away. The home they dreamed of raising their family in will never be owned by a family. It's now just another asset in a rental portfolio, its value measured by cash flow. For that couple, the dream is put on hold, maybe forever. They're pushed back into the rental market where their new landlord might just be the very company that outbid them. The impact goes beyond one family. It changes the character of a neighborhood. When a big chunk of homes are owned by distant corporations, the sense of community can start to fray. Homeowners are literally invested in their street, their local schools, their parks. Corporate landlords are financially invested. Their main duty is to their shareholders, not the neighborhood. This can lead to ghost landlords, faceless companies that are hard to reach for repairs and whose decisions are driven by algorithms, not people. Studies have shown that corporate owners can file for evictions more often than smaller landlords. This is creating a real shift in the country's psyche. Are we slowly becoming a nation of renters? If so, what does that mean long-term? When you're perpetually renting, you miss out on building equity. The money you pay each month builds your landlord's wealth, not your own. This widens the wealth gap and makes it even harder to get ahead, creating a permanent tenant class dependent on corporate balance sheets. Even some who support institutional rentals see the trade-off. They argue these companies provide professionally managed homes in good neighborhoods for those who can't buy. The flip side is they're actively taking those homes off the market for ownership, making the dream of buying even more distant. It's a cycle. Corporate buying drives up prices, forcing more people to rent, which increases demand for rentals, which incentivizes corporations to buy even more homes. This deep-seated frustration is what has set the stage for a political intervention, a declaration of war on America's new corporate landlords. Into this boiling pot of frustration, President Donald Trump dropped a bombshell. On January 7, 2026, he took to his Truth Social platform with a stunning announcement. He wrote that the American dream is increasingly out of reach, and then declared, "I am immediately taking steps to ban large institutional investors from buying more single-family homes, and I will be calling on Congress to codify it." The message was clear and populist. People live in homes, not corporations. The announcement sent immediate shockwaves through Wall Street. Stock prices for the biggest single-family rental companies, like Invitation Homes and American Homes for Rent, tumbled. Blackstone, the private equity giant that arguably started this trend, also saw its stock take a hit. According to reports, the companies were totally blindsided by the news. This was a direct shot at a multi-billion-dollar industry. So, what does this ban actually mean? The details are still emerging, but a few key things are clear. First, this is a forward-looking policy. The ban would only apply to future purchases, not force companies to sell the hundreds of thousands of homes they already own. It aims to stop the bleeding, not reverse the condition. Second, who counts as a large institutional investor? That's still a bit vague, but the proposal is designed to target the massive Wall Street firms like those owning over 1,000 properties. It's not meant to affect mom-and-pop landlords who own a handful of rentals and make up the vast majority of investor purchases in the U.S. Third, how would it work? President Trump mentioned two paths: executive action and new laws from Congress. He could potentially use executive orders to block these firms from using federal housing programs or federal loan guarantees. He could also direct federal agencies to prioritize selling foreclosed properties to individuals instead of in bulk to investors. But for a permanent Aussie sweeping ban, he needs Congress to pass a law. This is where it gets politically complex. Interestingly, the idea has found some bipartisan interest. Democrats like Senator Elizabeth Warren and Republicans like Senators Josh Hawley and Bernie Moreno have been critics of corporate landlords for years. Senator Warren even said, Congress should work on legislation to stop corporate investors from buying up homes. But similar bills have failed before, hitting a wall of industry lobbying and political division. So while the president can take some steps on his own, a lasting ban will be a tough fight on Capitol Hill. As for the timeline, President Trump has said he will provide more details during his speech at the World Economic Forum in Davos later in January. This suggests the administration is moving quickly. The war has been declared, and now everyone is waiting to see how the battle unfolds. All right, we are about to dive into the most important part of this entire story. What does this all mean for you? Will this actually make it easier for you to buy a home, or will it make your rent go up? The answers are complicated and full of surprising twists. If you're finding this breakdown valuable and want to stay ahead of the massive changes shaking up the economy, do me a favor and hit that subscribe button and turn on notifications. You won't want to miss what's coming next. This is where the rubber meets the road. War on Wall Street landlords sounds great, but what would the real-world consequences be? Is this a silver bullet for the housing crisis, a political stunt, or something that could backfire completely? Let's look at it from every angle, starting with the group this is all for, the first-time homebuyer. So does your path to homeownership just get easier? The argument for it is simple: fewer buyers mean less competition. Take the deep-pocketed, all-cash institutional investors out of the market, and the average family should, in theory, have a better shot. You're no longer bidding against a faceless corporation with nearly unlimited funds. This could, as one economist noted, bring prices down a little by reducing that top-end bidding pressure. In superhot markets like Atlanta or Phoenix, removing the most aggressive buyers could have a real cooling effect on the frenzy for starter homes. But, and this is a huge but, most economists agree that this ban alone will not solve the affordability crisis. The reason is that it attacks a symptom, not the root cause. The number one problem with the U.S. housing market is a severe lack of supply. We simply have not built enough houses. Most experts agree the U.S. has a housing shortage of somewhere between 3 and 4 million homes. Redfin's CEO called proposals like this mostly band-aids, stressing that the fundamental issue here is we need more housing. An expert at the American Enterprise Institute put it even more bluntly: if you're going to do all these demand-side things and you don't have any supply-side things, you're going to make the problem even worse. Think of it this way. If you have 10 people fighting over 5 chairs and you kick one person out, you still have 9 people fighting over 5 chairs. The problem is the number of chairs. This ban removes one type of buyer, but it does nothing to add more houses to the market. In fact, some experts warn it could even reduce the supply of new homes. Many large home builders have partnerships with these institutional investors, selling them entire blocks of new houses in bulk. This gives builders guaranteed revenue and helps them finance huge projects. If that guaranteed buyer disappears, builders might slow down construction. So, in a strange twist, a policy designed to help buyers could end up constraining the supply of new homes, keeping prices high. The bottom line for home buyers: this policy might clear out some frustrating competition, but it's not a magic wand for affordability. That only happens when we start building more homes. Okay, if the impact on home buyers is murky, what about renters? Will this finally bring relief from soaring rents? This is where the potential for unintended consequences gets even more alarming. On the surface, it seems logical. If firms can't buy more homes to rent out, maybe the rental market gets less competitive and prices drop. But it's not that simple. The most immediate worry is that a ban could actually reduce the supply of available rental homes, especially single-family rentals. These big firms are now major providers of this type of housing. If they stop buying and no one else steps in, it could shrink the rental pool. Basic economics tells us that when supply goes down and demand stays the same, prices go up. There's also the concern that these large, professional landlords often have the cash to invest in renovating and maintaining their properties. Upgrades a smaller landlord might not be able to afford. If the ban discourages this large-scale investment, we could see a decline in the quality of the rental stock. The other likely outcome is that these Wall Street firms won't just go home, they'll pivot. If they can't buy single-family homes, they will almost certainly redirect their billions into the multifamily sector, large apartment buildings, which are not included in the proposed ban. This could lead to a boom in apartment construction, but it could also lead to these same giant corporations owning an even larger share of the apartment market, potentially giving them more power to set rents in the future. For renters, the takeaway is deeply concerning. A policy meant to punish landlords could end up hurting tenants the most by shrinking supply and driving up prices. There's one more group affected by this that almost nobody is talking about: anyone with a retirement account. This includes tens of millions of Americans with a 401k or a pension plan. Many of these retirement funds are invested in the stock market, including in what are called real estate investment trusts, or REITs. Several of the largest corporate landlords, like Invitation Homes and American Homes for Rent, are publicly traded REITs. If you own a broad market index fund, you indirectly own a small piece of these companies. Their success contributes to your retirement savings. When Trump's announcement hit, the stock prices of these companies dropped significantly. A permanent ban could put sustained pressure on their business models and stock values. While the EB forward-looking nature of the ban limits the immediate damage, it casts a long shadow over their future growth. This means a policy designed to help Main Street could inadvertently harm the retirement accounts of the very people it's meant to protect. It's a perfect example of how interconnected our economy is. A move against Wall Street isn't just against billionaires. It can have ripple effects that touch the financial futures of teachers, firefighters, and office workers across the country. So if banning Wall Street won't fix affordability, what will? Across the political spectrum, from libertarian think tanks to left-leaning housing advocates, the answer from experts is deafeningly clear: build more housing. The crisis we're in is, at its core, a simple matter of supply and demand. For decades, the pace of new home construction has failed to keep up with population growth. The reasons are complex: restrictive local zoning laws, high land costs, a shortage of skilled construction labor, and a web of regulations that add years and costs to projects. Tackling this supply crisis is the only long-term solution. This means reforming zoning laws to allow for more types of housing, like duplexes and townhomes. It means streamlining the approval process for new construction. It means investing in training the next generation of builders. These solutions aren't as sexy as declaring war on Wall Street. They are slow, difficult, and require navigating complex local politics. Critics point out that this is exactly what Trump's plan lacks: a serious supply-side agenda. In fact, some of his own past comments have seemed to contradict the goal of affordability, expressing concern that building too many new homes could lower existing property values. This highlights the central political tension in housing. Policies that make homes more affordable for buyers would almost certainly mean that the explosive rise in home values that current owners have enjoyed would have to slow down. Blaming a single villain is a simple narrative for a complex problem, but as one analyst from Realtor, "Comme put it, institutional investors are largely a red herring. Even if you remove them entirely, it would not have a large enough impact to really move the needle on affordability." So, what's the bottom line? Trump's proposal to ban large investors from buying single-family homes is a bold move that taps into a very real and justified public anger. The image of families being outbid by faceless corporations is a powerful symbol of an economy that feels rigged. However, the potential outcomes are far from simple. For homebuyers, the ban might clear out some tough competition, but it doesn't solve the fundamental lack of available homes that drives high prices. For renters, the policy could backfire, leading to a smaller supply of single-family rentals and possibly even higher rents. And for millions of everyday Americans, it could have a hidden negative impact on their retirement savings. The consensus among experts is that this policy is, at best, a distraction and, at worst, could make the affordability crisis more severe. It's a demand-side tweak in a market screaming for supply-side solutions. The real, though harder, path to affordability lies in the unglamorous work of zoning reform, cutting red tape, and unleashing a new era of home construction. Ultimately, the war on Wall Street landlords may be more of a political battle than an economic one. It identifies a villain and offers a simple solution, often a winning formula in politics. But for those struggling to pay rent or save for a down payment, the unfortunate reality is that this war is unlikely to win you the peace of mind that comes with an affordable home. What do you think? Is this a necessary step to reclaim the American dream, or is it a dangerous distraction from the real problems? Let me know your thoughts in the comments below. And if you want to keep up with how these policies will affect your wallet, make sure you're subscribed. Thanks for watching.